What if I told you that a single choice in your retirement plan, one that seems honestly pretty minor, could end up saving you tens of thousands of dollars? Well, today we're diving into the pretty surprising world of annuity payouts, and we're going to look at a choice that has a much, much bigger impact than you'd ever think. So let's picture this. You're setting up your retirement income stream. You get to a fork in the road. Do you want your money delivered as one big lump sum once a year? Or do you want it as a steady, reliable check coming in every single month? Now, most people look at this and think, okay, this is just about my personal cash flow. Do I like to budget month to month? Or am I comfortable handling one large sum for the whole year? But what if I told you this seemingly simple choice has a hidden financial whammy that most people just completely miss? Okay, this is where it gets really interesting. Let's dig into the hard numbers and see how this choice can seriously affect your bottom line. I'm talking about the actual amount of money you need to put up to fund your retirement in the first place. Just look at this slide. This really shows the power of choosing monthly payments. Okay, so to get the exact same $60,000 a year in income, look at the difference in the premium you have to pay. For an annual payout, you'd need to put up somewhere between, say, $840,000 and $956,000. But to get that same 60 grand just paid out monthly, the premium you need drops to between $811,000 and $933,000. That's a huge difference. We're talking up to $40,000. I mean, think about that. Just by picking a different payment schedule, you could have an extra 40 grand of your own capital freed up. What would you do with that extra money?
And I know what you might be thinking. Okay, is this just a fluke, a one-off, cherry-picked example? Nope. This is a super consistent pattern you see across the entire annuity industry. In fact, let's look at some real-world examples from the big players to really drive this home. Okay, take a look at these major carriers. With Athene, choosing monthly saves you over $29,000. Move over to Penn Mutual, it's almost the exact same story. And even with Lincoln Financial, which is on the lower end here, you're still saving over $23,000 upfront. The data is just crystal clear. Monthly payments consistently require a smaller premium for the same amount of income. So we've established that monthly payments can be a way better deal. But why? It just feels a little counterintuitive, right? You'd think letting the insurance company hang on to more of your money for longer before paying it out, well, you'd think that'd be better for them, not you. The answer is actually buried in the fundamental way that annuities are built. Right. How is it even possible that getting your money more often actually costs you less upfront? It all comes down to this core insurance concept that is really the secret sauce behind how annuities work their magic. And that concept is called mortality credits. The easiest way to think about it is like a big shared pot of money. Everyone who buys an annuity from a company is contributing to this pot. Now, when someone in that group, that pool passes away, the remaining money doesn't just disappear. It stays in the pot, and it's used to fund the payments for everyone who lives longer. It's like a longevity bonus that lets an annuity guarantee you'll never, ever outlive your income. And here's the kicker. Here's why monthly payments get you a better deal. When the insurance company makes those smaller, more frequent monthly payments, they get more data points. It allows their really complex calculations to predict more accurately how much money they need to keep in that big pot. So that extra efficiency and that lower risk for them, they pass that on to you in the form of a lower upfront premium. Pretty cool, right? Now hold on. It is really, really important to know that this significant advantage doesn't apply to every single type of annuity product out there. And knowing the difference is absolutely crucial. So this monthly payment advantage we're talking about, it's specific to what we call annuitized income streams. That's where you hand over a lump sum and it gets permanently converted into a stream of guaranteed payments for life. It does not apply to products that use lifetime income riders, like a lot of fixed indexed annuities. See, those use a totally different formula. It's based on a benefit base and a withdrawal percentage, and with those, the payment frequency doesn't really change the math. Okay, so we've got the what, we've got the why. Now for the most important part. What does all of this actually mean for you? How can you take this knowledge and turn it into a real strategic advantage for your own retirement? Well, beyond the massive premium savings, there are other really practical benefits. First, it's just plain easier to manage your cash flow. You're getting a steady income stream, just like a paycheck, which makes it so much simpler to cover all your regular bills. And second, it helps spread out your tax liability over 12 months. This can help you avoid a massive tax spike that you might get hit with from a single large annual payment. The source material for this really puts it perfectly. It says, the choice between monthly and annual annuity payments is not just about convenience. It is a strategic decision that can influence your retirement income, tax planning, and overall financial security. This totally elevates the decision, right? It's not just a preference, it's a core piece of your financial strategy.
So the next time you're looking at retirement income options, just remember that a seemingly small detail can have this huge outsized impact. And that really leaves us with one final question to think about. Is your retirement plan overlooking this simple, powerful choice? Because you really don't want to let a small detail end up costing you tens of thousands of dollars.